Okay, so today we're going deep into the world of VC, venture capital. And you guys sent in some really interesting stuff that gets at like the core of how investment decisions are made in this space. And it seems like there's this real clash between using your gut, that intuition, and going with the hard data, using those numbers. What's interesting to me is that this gets at like how innovation actually gets funded.
Yeah, it really does. And the stuff you sent over really highlights how these two sides are kind of butting heads a little bit. I mean, we've got articles here that look at, the long-held beliefs in VC, how the industry is, well, sometimes can be a little slow to change, and some pretty convincing evidence that maybe a more, structured way of doing things could actually be better for everyone.
For sure. So what we want to do today is really get into these different points of view. Like, why are some of the traditional approaches so hard to shake? And ultimately, what does all this mean for the investors, the LPs, and for the whole innovation landscape that, let's face it, VC kind of fuels? So let's start with the classic VC approach. It's almost like there's this legendary image of the VC as this visionary, someone who can just spot the next big thing, the next amazing founder. It's almost mythical.
Yeah, that's a big part of it. There's this whole narrative around VCs being like these prophets with this incredible intuition. One article you sent really nails this. It says, and I'm quoting here, "The most powerful pitch you could offer to an LP is that you have incredible intuition on founders and markets. Some qualitative secret sauce for identifying potential that defies quantification." It's so interesting how much emphasis is put on this idea. There's this magical ability to see the future of success that regular people just don't have.
Right. And you can kind of see why LPs buy into that. I mean, at the end of the day, they want those big returns, the alpha, right? And the idea of a VC firm having this like secret formula for picking winners, well, that's way sexier than just crunching numbers, right? The article even says, a slow and steady venture is a numbers game pitch is much less emotionally compelling than I am a rock star who can consistently beat the odds. It's almost like the story is more important than the actual process for getting that initial investment.
Exactly. It's all about concentrated bets, big swings, driven by this like gut feeling.
Yeah.
This idea has been around in VC forever. It basically says the real wins come from finding those hidden gems that everyone else misses.
Right.
And to do that, you need to have this almost, I don't know, prophetic vision or something.
Okay, so we've got this, almost romantic idea of the intuitive VC. But then the stuff you sent also pushes back pretty hard on this. It kind of suggests that maybe this whole approach is becoming a little outdated. One article even uses this image of an ostrich burying its head in the sand. Like, that's a pretty strong statement.
Yeah. And what they're saying is that the whole scene has changed, especially in tech and healthcare. The article you sent actually says the dynamism of technology and healthcare markets since the bubble period has broken venture's concentration curse. So what's really fascinating here is this idea that top-notch companies are popping up everywhere, not just in Silicon Valley. They're coming from all over the world, started by younger people who aren't necessarily part of those old boys networks.
So basically, the pool of potential game changers has gotten so much bigger. It's not just who you know in a small circle anymore.
Right. And that really challenges the idea that you need this special insider intuition or access to deals within, a limited network. This concentration curse is being broken because there are just so many more startups. They're spread out everywhere.
And that kind of leads us to this idea that a more, systematic, process-driven way of investing might actually make more sense in this new world. The articles you sent touch on this, suggesting that, looking at the data could lead to more predictable and maybe even better results. What does that even look like, though?
Well, process-driven investing could mean, setting clear criteria for evaluating companies, using scoring systems, analyzing past investment data to inform future decisions. It's about moving away from just, gut feelings about a founder's personality. What's really interesting is that there's actual evidence this can lead to more consistent returns. It's often a much more disciplined way of managing risk and reducing those individual biases that can sometimes creep in.
Okay, so theoretically, this more data-driven approach sounds like it could be better for LPs, more stable returns. But like we were talking about before, it seems like that kind of pitch, like we use data to make smart investments, it just doesn't have the same punch as the Rockstar VC story.
That's a good point. Because even if the data says process-driven investing works better, there's this big hurdle when it comes to how investors see it. And this is where we get into this thing called algorithm aversion.
Right. So basically, we humans, we tend to trust decisions made by algorithms less, even when those algorithms are proven to be more accurate. It's kind of weird when you think about it.
Absolutely. And one of the articles explains this perfectly. It says, seeing a model make relatively small mistakes consistently decreased confidence in the model, whereas seeing a human make relatively large mistakes did not consistently decrease confidence in the human. Like, that's pretty wild, right? We expect algorithms to be perfect, and if they mess up even a little, we lose faith, but humans can make huge mistakes, and we're still like, okay, no biggie. It makes you wonder why that is.
Yeah, it's like we think machines should never be wrong, but humans, well, they're allowed to make mistakes. So basically what you're saying is this could be a huge barrier to using these more effective data-driven methods, especially in fields where, it's always been about human expertise.
Exactly. And you can see how this plays out when LPs are deciding where to put their money. Even if a data-driven VC fund shows better returns over time, if their models make a few small errors, the LPs might freak out more than if a gut-feeling fund makes a few big blunders.
So even if the numbers say this is the better way, our brains might be pushing us towards the flashier gut instinct approach, even if it's not actually the best way to go. And this whole reluctance to go all in on data, well, it seems like that has some pretty serious downsides, according to the research you sent. One article even talks about predictably bad investments. That's a pretty harsh phrase.
Yeah. So
Yeah.
basically, this study compared actual VC investments to what an algorithm would have predicted based on the information available at the time. And the results were kind of shocking. It said, by comparing investor choices to an algorithm's predictions, I show that up to half of the investments were predictably bad based on information known at the time of investment. The predicted return of the investment was less than readily available outside options.
Half. Whoa, that's huge. It's like saying that a big chunk of VC money isn't going to the most promising companies, but instead to companies chosen based on, well, less objective factors. But, I mean, isn't early stage investing always kind of risky? How much of this bad is just, the nature of the beast?
Well, that's a fair point. But the study actually took that into account by comparing the predicted returns to, like, baseline investment options that were available at the time. And the fact that a bunch of these VC investments still underperformed those safer options, well, that suggests something else was going on besides just normal risk.
Right. And that brings up this whole issue of, what VCs owe to their investors, the LPs. I mean, they're supposed to be protecting their investors' money and making choices that are in their best interest, right?
Yeah. Absolutely. And one of the sources is pretty blunt about this. It says, and I'm quoting here, VCs have a fiduciary duty to safeguard their investors' capital and make the most appropriate decisions that align with their investors' risk preferences and best interests. This study's results indicate that VCs do not always perform their fiduciary duties and, at least some of them, flagrantly disregard the risk preferences of their principals and concede to taking advantage of naive investors to maximize personal gains. That's a pretty serious accusation. It really makes you question the accountability in the industry.
Yeah, it does. It points to, like, a potential dark side of this whole intuition thing and the lack of transparency you sometimes see in VC. If a bunch of investments are, predictably bad, you have to wonder if those decisions were really made with the LPs in mind or if there were other factors at play.
And that takes us to the last big point in all this. LPs need to be more skeptical and really push for more data-driven practices in VC. I mean, the idea that this mystique around venture capital has been holding it back for decades is a pretty strong argument.
Okay, but how can an LP actually do that? What kinds of questions should they be asking?
Well, one of the articles says, it's time that LPs stepped up their diligence and put more pressure on GPs to actually follow the data, to implement best practices, and to take full responsibility as a fiduciary. So basically, LPs need to demand transparency. They need to know how investment decisions are being made, what metrics are being used to judge potential investments, and how past performance data is being factored in.
So they should be looking past the smooth talk and demanding to see the actual process and data behind those investment choices.
Right. They need to ask for detailed reports on how their portfolio is performing, what criteria are used to evaluate startups, and even how the fund tries to reduce bias in its decision-making. And there's actually some optimism in one of the articles. It suggests that the power dynamic might be shifting towards the LPs, which could give them more leverage to demand these changes. It says, it seems clear to me that this change will not come easily to venture capitalists who are either comfortable with the status quo or simply find it convenient. However, it might be possible for LPs to set new terms as market dynamics have shifted power in their direction.
So basically, the market itself might force VC to become more data-driven. If LPs get smarter and tougher in their due diligence, they're going to start favoring funds that can prove they're making decisions based on data and process, not just gut feeling. So to sum it all up, what we've been looking at today is this really interesting clash in the heart of VC. The allure of the brilliant, intuitive investor versus this growing body of evidence that says a more data-driven, process-based approach might actually be better and definitely more reliable for investors. And this tension seems to come from a mix of, well, long-held industry beliefs, our own biases against algorithms, and maybe even, in some cases, some misaligned incentives.
Totally. And understanding this whole interplay, well, it's essential for anyone who's involved in or even just interested in finance and innovation. It helps explain how those big high-stakes decisions are made in the face of so much uncertainty. And it also explains why some practices that seem, well, kind of illogical might still be sticking around.
Absolutely. And it makes you wonder, if we as humans are so quick to trust human intuition over algorithms, even when the algorithms are better, is this happening in other areas too? Are there other fields where we're clinging to gut feelings even when the data says we shouldn't? It's a question that goes way beyond just VC, I think.
I think you're right.
Okay, that's our deep dive for today. Thanks for joining us.
Thanks for having me.